Welcome to Mr. Marshall's Market. Block released earnings last week for the second quarter and has been on quite a ride since then. Let's dig into the results and some overall thoughts on the stock. Going into the second quarter earnings, Block was still recovering from the report dropped by Hindenburg Research. The stock was up a little over 20% for the year pre-earnings. Q2 earnings came in beating both top and bottom line estimates. Earnings per share came in at 39 cents, which was a 2-cent beat. Revenue came in at $5.53 billion, a $430 million beat, and gross profit came in at $1.87 billion, a 27% year-over-year growth. Despite these strong numbers, the stock dropped 20% on the earnings released from just over $80 a share down into the mid-60s, where it has stayed since. Overall fear in the market seems to be driven by gross payment volume growth slowing down and net income decreasing versus last quarter. Despite seeing growth in revenue, gross profit, and Cash App peer-to-peer volume, the stock was sold off. I think there are 4 main things to consider about the stock. But first, if you find this video helpful, please like and subscribe to get more stock news and help feed the algorithm. The first thing to think about is the growth payment volume growth slowing down. It still grew faster than the major networks, at 12% versus 6 to 7% in the major networks. This slowdown is expected since they cut back some of their spend on customer acquisition in efforts to be more efficient. The overall growth is appearing to be efficient, as seen by the health and gross profit growth, and management also spoke to the average return on investment for new customers being faster than what they have historically seen. Customer retention for the new cohort is also reported to be strong. As long as gross payment volume grows faster than the major networks, then I don't believe there should be too much concern around this. The second thing to consider is net income decreasing by a little over $100 million more than the prior quarter. This was due to them writing off Verse and Clearpay in certain markets, as well as some of their real estate assets. I also don't see this as much of a problem, as the company is restructuring and focusing on efficiencies. As they look to become more efficient, it makes sense that some areas of the business would need to be cut. If this continues for multiple quarters, this will be a cause for concern, but as it stands right now, I'm not too concerned about this. The third thing to consider is that international markets continue to grow, and the company is still less than 1% penetrated in international markets, so there appears to be a long growth runway for the company to tackle. The fourth thing to consider is the large growth continues to be seen by mid-market sellers, which Block defines as merchants making up more than $500,000 in annualized gross payment volume. These large sellers continue to make up more of Square's gross payment volume, up to 40% in the second quarter for 2023. I believe the focus on larger sellers is a great move by management, as those larger sellers will have more use for the expanding ecosystem of features being built out on different platforms. Overall, it appears that the markets are overreacting to near-term headwinds while not seeing the strength in the overall business. The stock is now trading for 20 times 2025's estimated earnings and just under 2 times current sales. This is the lowest it has traded yet. For a stock with a long runway of growth, it appears to me to be undervalued. What are your thoughts about Block? Please let me know in the comments below.